Hi, everyone. Dan Gerard, along with Michael Crotty and from G9 Financial. And we have a special guest today, Tim Holland from Brinker Capital Investments. Before I let Mike introduce Tim, I hope everyone is staying safe and healthy out there and amongst the craziness that we're all dealing with. And hopefully the holiday season, everyone does continue to stay safe and healthy. With that, Mike is going to introduce Tim to talk about a little bit about the current market environment, our recent political change, and what's going to happen for 2021, hopefully.
Awesome. Thanks, Dan. And thanks, Tim, for joining us. Everyone, Tim Holland is a Senior Vice President of the Global Investment Strategist at Brinker Capital. His job at Brinker Capital is one of our investment managers that we use quite often with our clients, and we're happy to have Tim on. Tim's job and role is related to market outlooks as well as help with strategic asset allocation. So thanks, Tim, for joining us. We appreciate it. So first question I think we have on our minds and what this is really focused on is obviously the post-market markets. And what are we looking at with the Biden presidency? Fill us in on a few. I know you got some good slides to show us on where we are with that. So take it away.
Yeah, no, that's obviously top of mind, Mike, coming through the most divisive election in generations and with inauguration day, sort of 6-7 weeks out. So, we've got our presentation up on the screen and the cover slide speaks to this post-election environment. So we've titled the deck, we voted, now what, right? And what the election means for policy and the economy and the markets into 2021. And so what I'll do, if this works okay, my tech skills are still under development. I'll jump to a couple slides that speak specifically to how markets have done under different political constructs and what we might expect going forward. So the first point I'd make is, markets have done well under both parties, right? And so what you see up on the screen, hopefully, is a data set that looks at returns under every presidential administration going back to Harry Truman. And we annualized for a 4-year average return because not every president served a full 4-year term, or obviously someone on to serve 8 years, right? The tragic assassination of John Kennedy, Gerald Ford, sort of that interim presidency between Nixon and Carter. And what you see is that going back to the 1940s through the end of October, markets have done well under a Democrat president, a Republican president. The Democrat return has been a bit better, 9.5% to about 6% for Republican. To my Republican friends on the webinar who might take issue with that number, or to my Democrat friends on the webinar who might be inclined to crow a little bit about those extra 300 basis points, I would note that a lot of life is timing. So if you look at maybe the return stream under Bill Clinton or under Barack Obama, Bill Clinton was inaugurated in early '93. The economy was already out of recession and the market was already beginning its epic run of the 1990s. And under Barack Obama, he was sworn in early '09 and the markets bottomed March of '09. I'm not saying neither one of those presidents didn't do a good job, but a lot of life is timing. But again, markets have done well under Democrat presidents and Republicans. But markets really like divided government. There are lots of Wall Street adages, call them cliches if you want. One is markets like gridlock. And that's because of another market adage, which is the market hates uncertainty. And so to get big things done in DC, you need to control both ends of Pennsylvania Avenue, right? You need the White House and the House and the Senate. And when you control both ends of Pennsylvania Avenue, you can do big stuff, different stuff. And the markets don't often like big, different stuff. The market's like certainty. And if the market knows that nothing's going to get done because DC is divided, well, the market's probably pretty happy with that. And so if you look up on the screen now and you go left to right, you just see the return streams for the S&P 500 on an annualized basis going back to the 1930s. And what you see is that the best return streams have come when one party controls the White House and the other end of Pennsylvania Avenue is controlled by the other party or split. And so if you go left to right, you see 13.6% average annual return with a Democrat in the White House and a divided Congress, and 13.4% with a Republican in the White House and a divided Congress. So if history is any guide, we're about to get a political construct that the markets liked more than any other. And that's a Democrat in the White House and a divided Congress. And we've got two very important runoff elections in Georgia on January 5th that will determine what party controls the Senate. Right now, the Republicans, because of the flipping of the Senate seat in Arizona, but the picking up of a seat in Alabama and the flipping of a seat in Colorado from R to D, the Republicans have a 52-48 majority. Our best thinking is the Republicans hold both seats in Georgia. Mitch McConnell remains majority leader. Obviously, Nancy Pelosi will be speaker, and you've got Joe Biden in the White House. And we think one of the reasons why the markets continue to do so well post-vote is the market really likes this outcome. And we think the market's right to have embraced the outcome of the November 3rd vote. So the presumed policy implications of the vote, right? Politics don't matter. Policy does, but you have to win at politics to set policy. So we're going to make a couple of assumptions. And the big one is that the Republicans win both of those Senate runoff elections on January 5th in Georgia. So if you're a political junkie like I am, pay attention to Georgia. That's where all the action is between now and early in 2021. But if that does happen, taxes are not going up. Right. I know Joe Biden would like to increase taxes. The Democrats have talked about doing that. You can agree or disagree with the policy. That's not going to happen if Mitch McConnell is majority leader. The downside to that is, and there's been a lot of talk about this in the press of late, is that the odds of meaningful fiscal support, something along the lines of the $2.1 trillion CARES Act from earlier this year to help the economy continue to get through this awful pandemic, well, the odds of that have gone down a lot as well. So you're probably going to get some incremental fiscal support, but not a $2 to $4 trillion check, which is probably what we would have seen under a quote unquote Democrat blue wave scenario. So you'll get incremental support, which means the economy, which has bounced back meaningfully, continues to move in the right direction, but it doesn't accelerate. The upside of that is inflation remains low, bond yields remain low, and that means PE ratios for stocks can remain high, right? So that's supportive of equities. The dollar probably continues to weaken a little bit. U.S. stocks are probably going to continue to move higher, though we wouldn't be shocked by a little volatility near term because the market's done so well. And in this environment, and we're going to talk about this in greater detail, of low interest rates, low inflation, good economic growth, but not accelerating economic growth, growth companies should outperform value companies, meaning companies that can grow in an okay but not great economic environment should continue to find favor with investors. And for those portfolios where we have discretion, where we build those portfolios, we've overweighted U.S. equities relative to the rest of the world, and we've overweighted growth relative to value. So
I guess that's a big question
Mike,
we have, Tim, is obviously talked about growth and value. And this is getting a little into the minutia, but we have some clients that ask these questions. So how long does that last, growth versus value in U.S. over international? What are the triggers that might change? And I think you had said earlier that when we were talking that is something you're closely watching.
Yeah. So I think one thing that I've really come to appreciate in the last 10 or 12 years, Mike, is that trends can remain in place a lot longer than one thinks. And by that, I mean, growth stocks have easily outdistanced value stocks for the past decade. And U.S. has easily beaten the rest of the world. But there are always inflection points, right? Trends don't remain in place forever. But again, there's been a persistency to a couple big ones. And the third one being sort of a low interest rate, low inflation environment. So we've been overweight growth. That's been the right place to put capital, growth versus value. So what might change that? Well, a challenging macro environment will continue to favor growth. So a solving for this awful pandemic, or maybe you do get a meaningful fiscal package out of Washington, D.C., maybe it's early 2021, that really sort of supercharges the recovery. Well, all of that's going to be good for value because value stocks tend to need more of a cyclical or economic tailwind pushing them along, whereas an Amazon or an Apple, to take some of the better known bigger growth companies, can grow through almost any environment because they've built such powerful business models. Low interest rates favor growth stocks because growth stocks tend to trade at higher multiples, meaning people are willing to pay more for them. But if rates go up, then all of a sudden that helps financial stocks like banks, and it also makes those growth stocks look a little less attractive. So in a low interest rate, modest growth world, growth is going to do well. And that's what we've seen for a long time now. If you saw growth pick up meaningfully, that should pull inflation and interest rates up. All of that's going to help classic value stocks like banks, financial services stocks, and it's going to make those growth companies look a little less attractive, and probably would see capital go from growth to value. And you've seen some of that of late. The big question is, are we at that inflection point, or is this another head fake in a series of head fakes over the last 10 years or so? We're not ready to give up on growth yet, but those are some of the things we're paying attention to.
Awesome. Well, thanks, Tim. This was hugely helpful to us. It sounds like divided government is a good thing. Looks like we should have a pretty good 2021 with some early volatility. Watching growth versus value and U.S. versus international are the key factors, and obviously keeping an eye on the vaccine and stimulus.
Yeah. Right. Yeah. No, I think that's it. And as Dan, mentioned earlier, on behalf of everyone at Brinker, we all hope you're all well and safe and healthy and navigating this difficult period as well as possible. We appreciate the opportunity, Mike and Dan, to share our thoughts with you all. And I think at the risk of sounding Pollyannish, because we're not to the other side of this thing yet, obviously, and it's been a devastating pandemic here at home and around the world. But, if you think about the amount of intellectual capital and financial capital we've thrown at this awful virus and where we are right now and the progress we've made, it's stunning, right? So it can be hard to be optimistic in times like these, but man, what we've seen on the vaccine front, the R&D front, the way we're solving for this or trying to figure out, there's a lot of good news out there too. It's pretty heartening as we go into year end.
That's good to hear. So everyone, thanks for joining us. If you have any questions on how this is going to impact your portfolios or your plans, reach out to Dan, Mike, Elisa, or George, and you can catch us at www.g9financial.com. Thanks and have a great day.
Great. Thank you, everyone.